Imagine logging into your 401k or pension account a few months before your planned retirement date, looking at a balance of $300,000 and assuming every single dollar is yours to keep. You hand in your 2-week notice, pack up your desk, and wait for the rollover check. But when the transfer clears, you notice $40,000 is missing. You call HR in a panic, assuming there was a processing error, only to hear 3 words that cost you a chunk of your nest egg: you weren't vested. This scenario happens far more often than it should. As you approach retirement or transition out of the workforce, understanding the mechanics of your employer-sponsored accounts is just as important as knowing how much you have saved. Today, we are answering a fundamental question that can directly impact your retirement timeline and bank account. What is pension vesting? At its simplest, vesting means ownership. It is the legal right to keep the money, stock, or pension benefits that your employer has put into your retirement plan on your behalf. To understand how it works, we first need to separate your money from your employer's money. Any money you personally contribute out of your paycheck into a 401k, 403b, or pension system is always 100% yours from day one. If you quit tomorrow, your employer cannot take back a single penny of your salary deferrals or the growth on those specific dollars. Where vesting comes into play is with the money your employer adds to the pot. This includes company matches, profit-sharing contributions, or traditional pension benefits. Companies do not give away this money unconditionally, they use it as an incentive to keep you working there longer. Until you meet specific time requirements set by your company, that extra money is considered unvested. If you leave the company before hitting those milestones, you forfeit some or all of those employer-funded dollars, and that money goes right back into the company's plan. So how do companies structure these timelines? Generally, vesting follows one of 3 primary schedules: immediate, cliff, or graded. The first, and most straightforward, is immediate vesting. Under this structure, 100% of the employer's match or contribution belongs to you the exact moment it hits your account. If your company uses a safe harbor 401k design, for example, immediate vesting is required by law for matching funds. The second type is cliff vesting. Picture walking toward the edge of a cliff. Until you reach the edge, you have zero ownership. The day you hit your 3-year work anniversary, you jump straight from 0% ownership to 100% ownership. In traditional defined benefit pensions, the kind that pay a guaranteed monthly check for life, cliff schedules are very common, often requiring 3, 5, or even 10 years of service before you earn the right to a monthly check in retirement. The third structure is graded vesting, sometimes called graduated vesting. Instead of an all-or-nothing milestone, graded vesting gives you ownership in increments over a period of time. By federal law, a standard graded 401k schedule cannot take longer than 6 years to reach 100%. A typical structure might give you 0% vesting for the first year. In year 2, you become 20% vested. In year 3, 40%. In year 4, 60%. Year 5 brings 80%, and by year 6, you are 100% fully vested. If you were to retire or change jobs after year 4 under the schedule, you would get to keep all of your personal savings plus 60% of whatever the company matched over the years. The remaining 40% of the company match would be returned to the plan. Now, if you are nearing retirement age, there is a crucial rule you need to know that often works in your favor. Federal regulations stipulate that when an employee reaches the normal retirement age specified in their plan documents, which is typically age 65, they automatically become 100% vested in all employer contributions, regardless of how many years they have worked for the company. Additionally, if a company undergoes a total or partial plan termination, such as during a massive corporate restructuring, affected employees often become fully vested automatically. However, you should never rely on assumptions when timing your exit from the workforce. The timing of your resignation or retirement date can make a massive financial difference. For instance, if your company calculates vesting based on calendar years or full anniversary dates, leaving on December 15th instead of waiting until January 2nd could mean forfeiting an entire year's worth of vesting credit. Leaving just 2 weeks too early could cost you thousands or even tens of thousands of dollars in employer funds. Furthermore, for those with traditional pensions, vesting determines whether you receive a pension check at all. If you are unvested in a defined benefit pension when you leave, you do not get a monthly annuity later in life. If you are vested, you have secured a lifelong income stream that will be waiting for you when you reach the plan's payout age, even if you left the company years prior. How do you make sure you don't leave money on the table? Here are 3 concrete, actionable steps to take immediately. First, request your summary plan description, often called the SPD, from your Human Resources Department or Benefits portal. This document legally outlines the exact vesting schedule, how years of service are calculated, and what constitutes a break in service. Pay close attention to how your plan defines a year of service. Many plans require you to log at least 1,000 working hours within a 12-month period to receive credit for that year. Second, look at your latest retirement account statement and find 2 specific lines: total account balance and vested balance. The difference between those 2 numbers represents the money you will lose if you walk away today. If your total balance is $250,000 but your vested balance is $220,000, there is $30,000 currently on the line. Third, align your planned retirement date with your vesting milestones. If you find out that you are 80% vested and reaching your next work anniversary in 4 months will push you to 100%, it almost always makes financial sense to adjust your retirement timeline by those 4 months to secure that remaining 20%. Retirement planning isn't just about how much you save. It's about making sure every dollar tied to your name actually belongs to you when you walk out the door for the last time. Taking 20 minutes today to verify your vesting status can protect the wealth you've spent a lifetime working to build.